All right, now folks, what we're going to do is we're going to now dive back into estate planning land. Is my mic not loud enough? Do I need to make a bad joke? All right, guys, we're going to come back from break. Is everyone back? Everyone ready? My wife does this trick as a school teacher where she counts to 3. 1, 2. Nobody cares. See, I'm not a first grade teacher. I can't do it, right? All right. All right, guys, we're going to get back into it here. Okay, now, what we're going to get into next, folks, we're going to get back into estate planning land here. We're going to talk about why do we need a will? Why do we need a trust? What do those things do for us? And why are those important, okay? Now, before we get too deep into the conversation of whether or not you need a will or a trust, we have to get some basic things. Guys, excuse me. Hey, guys. Oh, folks, we're going to get started, guys. Sorry, guys, we're going to get started again, okay? I love that everyone wants to mingle, though. Listen, we're going to mingle afterwards. We'll have plenty of time to talk, and we have hors d'oeuvres and fun stuff, all right? Well, like I was saying, we're going to get back into estate planning here. We're going to talk about whether you would need a will or a trust, what do those things do for you, and how can they help your family, all right? Now, before we get too deep into that conversation, again, we have to start backing up and getting into some more basic things. And one of the things that's very important to understand before we get into this discussion are the different ways we can own assets, all right? Now, there are basically only 3 different ways you can own something. Number 1, you can own it jointly with somebody else. What's nice about jointly owned property from an estate planning perspective is when one of the owners passes away, the survivor just owns it automatically, all right? Nothing has to happen. You don't have to open an estate. You don't have to go through probate. It's just automatically owned by the survivor. That's why most married couples try to own almost everything they can jointly, right? When our spouse dies, we don't want to have to do anything from a legal perspective or open an estate. We want it to be pretty much automatic, all right? That's why when you're married, you own almost everything you can jointly so that it's in both of your names. Now, the other way you could own something is it could be a beneficiary designated account. That's the second way we can own things. Again, pretty basic, folks. It's an account that when we create it, at that time, we name a beneficiary. And again, when you pass away, that account just goes directly to the person you name automatically. You don't have to open an estate, doesn't have to go through probate, just goes to them automatically. The third way we can own things is individually. If you own something in your name alone, that's where there's a big difference, okay? The things that we own individually must pass through your will when you die to get to somebody else. So those first 2 categories we mentioned, the jointly owned property and beneficiary designated assets, these are all what we call non-probate assets. All right, they do not have to go through an estate to get to somebody else. They just go directly to the person named. Now, don't confuse non-probate, though, with non-taxable, okay? Thank you. So many people come in, and that's the reason they want to avoid probate. Well, I don't want my kids to pay inheritance tax, so we're not going to let anything go through probate. Well, that's fine, but I have bad news about the tax issue, all right? Just because it's a non-probate asset doesn't mean it's not subject to inheritance tax. The only thing not subject to inheritance tax, folks, is life insurance. And that's because the legislature said so, all right? There's no other reason. They have really good lobbyists, all right? So, if we know that that's the case, let's talk about how we get things to other people. And it's going to come back to something Jeff touched on, outright distributions versus distributing things to a trust. Again, the problem with having jointly owned assets and beneficiary designated assets is that they do go directly to a beneficiary. And usually that beneficiary we name is a person, right? My spouse first. If my spouse isn't here, then I want my children to be the contingent beneficiaries, right? But again, folks, when we leave things to people directly in those outright distributions, once that happens, the assets are now subject to the things that can go wrong for that person, right? If I leave everything to my spouse, like we've touched on, right? Maybe she could make a bad remarriage decision, or her health could fail and she could end up needing long-term care. She could cause a car accident after I die and get sued for all the money I've left her, right? That's the negative with an outright distribution, okay? If it goes to a person, it's subject to the things that can go wrong to that person. A better way to do that is to not name a person as the one who's going to receive things. You could have those things be sent to a trust when you die for that person's benefit. And as I'm going to show you here in a couple slides, trusts work very differently from how most people think they do, all right? Most people think that a trust is something only for fabulously wealthy people and it's a means to control everybody, right? But that's not really the case anymore, all right? The way we do trusts nowadays are different. We don't do them to control people, we do them to protect people. Now, again, a will and a trust is part of your overall comprehensive estate plan, all right? That's what it does. We've talked about powers of attorney at length so far today. That's a very important component of your estate plan. But the other part deals with that third question we talked about, what happens when you die, right? Again, if you have a will, well, that's only going to control certain things, right? Just the things you own in your name alone when you die. And the thing about a will is a will has to go through this thing called probate, right? Does anyone here like probate? Right? Everyone wants to avoid it, right? Can anyone here tell me what probate is? Okay, pretty good, right? The administration of a will. It's a process. That's what it is, guys. It's the legal process that we have to go through to carry out the instructions in your will, all right? Now, this process is what people don't like because it takes time. What you have to do is you have to fill out an inheritance tax return. That's a very complicated thing to do. You have to make sure the inheritance tax gets paid. That's what Pennsylvania cares about, all right? And then once that process is almost done, you have to have it approved by the Department of Revenue, which takes forever, all right? It can take up to a year to get that approval. But the reality here in Pennsylvania is something that Jeff touched on. You really can't avoid this negative, guys. If you don't have a will or you send everything to a trust, when you die, that trust has to be emptied out as well, all right? And that's just a different name for the same process. We call it trust administration, but it's essentially the same thing as probate, all right? So again, don't get confused between probate versus inheritance tax. Very different issue. Now, let's talk about this in more detail, guys. What is a trust? Well, a trust can be a hard thing to wrap your head around because a trust is just a contract. It's a contract between three different parties. The first party to that contract is what we call a grantor. That's just the person who creates the trust and puts their stuff in it. The second party to a trust is the person who controls what's inside of it and writes the rules about what happens to it. That's what we call a trustee. And the third party to a trust is what we call a beneficiary. That's the person who's to benefit from what's in that trust. Now, if you all had to pick, how many here would want to be a grantor? Just the elder law nerd? Anyone in the back? No, all right, that's fair. A couple. Okay, good, good. All right. How about a trustee? Who'd want to be a trustee? Not one control freak in the whole... Okay, one. All right, we got a control freak. All right, good. How about a beneficiary? Oh, yeah, put both hands up for that one, right? That's good. Well, listen, what if I told you that you could be all three at once? Because you can, all right? You can be the one who creates your trust. You can be the one who controls everything inside of it. It can all be there to benefit you while you're still here. Now, even though that we now know that's what a trust is, like Jeff had mentioned earlier, it's still kind of hard to wrap your head around that, right? So what we use at our firm to help you as a visual aid is a little red wagon, all right? If you think about this little red wagon, guys, it's no different than what a trust is today. Think back to when you were kids, right? If you had that little wagon, who got to decide what went in it? Right? That was you. Exactly, right? While you were wheeling it around the neighborhood playing all day, who got to decide who else plays with what's in your wagon? Yep, right? Also up to you. And at the end of the day, who got to wheel it home so it was waiting for him the next morning? Also you, right? Or mom, right? Exactly. Or dad, right? Well, that's why, guys, a trust is just like these little red wagons, all right? We have these in every room in our office, and Jeff and I have them on holsters just in case someone wants to learn about it, all right? But this is what I'm going to use today to teach you how a trust works and what it can do for you. And the first thing I have to teach you about is a very important difference with a trust. It's the difference between a revocable trust and an irrevocable trust. Now, if the trust I created here is revocable, anytime I want to, once I put my things in it, I can reach in there, take it out, and give it right back to myself. Which sounds pretty good, right? But it's not, because a revocable trust does not give you asset protection. And here's why. There's a pretty basic rule of law when it comes to debtor-creditor relationships here in Pennsylvania. That rule says that my bad guys in life, things like my lawsuit, my nursing home, my creditors, well, they can all do whatever I can do as an individual. So if I can reach in here and take things out, so can they, right? So could a lawsuit, so could long-term care. I don't have asset protection with a revocable trust, guys. If I want asset protection, what I have to create is an irrevocable trust. Now, if this trust I've made is irrevocable, it has one major difference, gang. Once I put my stuff in here, the only thing I'm not allowed to do is reach in, take it out, and give it back to myself. Which I know sounds bad, but if you think about it, that's what protects my assets, gang. If I cannot reach in here and take things out, neither can my lawsuit, neither could my creditor, and neither could a nursing home. Now, once I have these things in here, remember, I'm also the trustee. So I decide what I do with these things, guys. If I put my house in here, for example, I'm the only one that decides who lives there. Nobody can throw me out. If I want to sell it, I can. If I want to buy a new one, I can. Is that any different than how we own our house today? No, right? If I put my investment account in here and I decide I need to change to a new financial advisor for some reason, go ahead. You can move it to a new company. You can do whatever you want. The only thing you can't do is reach in, take things out, and give it back to yourself. Now, it wasn't all that long ago that I did an irrevocable trust for my mom, okay? My mom never earned a whole lot of money in life. She was a volunteer. She was a minister. And about 5 or 6 years ago, her dad passed away unexpectedly. And while we thought he was dirt poor, he had $840,000 in savings bonds sitting in his furnace room in a box collecting dust, all right? Can't make it up. 6 kids in that family. That was fun. But when my mom finally got her slice of that inheritance, it was very important to me to keep that safe for her because that was a nice nest egg for my mom, all right? And I worry about her. She's had some health issues in the past, and I don't know what the future is going to look like. So, of course, I came home for lunch one day, brought my little red wagon with me, and I was teaching Mom about how this was going to make her safe, right? And when I got to this point, I knew something was wrong because she was giving me that international sign for distress for a mother. The lip bite, all right? And she wasn't talking, all right? So I stopped and I said, Mom, look, what's bothering you about this? And she said, well, look, I know I'm a pretty simple person, but what if I want to take some of that money out of there and do something fun? What if I want to buy a new car or take a trip or, I don't know, anything that I might want to do later in life? And I told her, look, Mom, you can get anything out of here anytime you want. You just have to do it in a certain way. While you're not allowed to reach in, take money out and give it to yourself, you are allowed to give things to anybody else in the world that you want to, Mom. So if you want, say, $50,000 out of there to buy a new fancy car, here's what you're going to do. You're going to write a check to me, your son, for $50,000. I'm going to cash that check. As soon as it clears, I'm going to turn around and write her back a check as Mom for the same $50,000. Once she cashes it, she can do whatever she wants with it, right? There's no tax implication to any of us in doing this because we're making gifts, right? And how much can we give away before we die, tax-free? $12 million, $40,000, right? So unless I do that little hokey pokey with my mom more than $12 million, $40,000 worth of times, nobody pays any tax on this. And I thought that was going to make Mom feel good, right? She knows she can get her money out, no problem. But when I looked at her, she looked even more upset. And I said, Mom, now what's wrong? And she said, oh, honey, I don't want to hurt your feelings. And I said, Mom, you gave birth to a lawyer. I don't have feelings, all right? Just tell me what's wrong, okay? So she said, fine. What if I write you that check for $50,000 and you forget to answer your phone and you go away, and right? What if I don't write the check back? And I said, look, Mom, you're forgetting something, all right? You're the trustee and you're also the grantor. That means you write the rules about what happens to this stuff even when you die. And you can change those rules anytime you want, Mom. So if I would get a check from you and I would refuse to write it back, what can my mom do to me? Write me out of the will, and that means my sister gets everything, and I'll never let that happen, all right? So that's how my mom has pressure over me. She could write me out of the will, and I wouldn't receive anything when she dies. But that's how an irrevocable trust works, gang. Once my mom has all of her assets in here, now she has options, right? If she gets sick later in life, and she needs that kind of care we've been mentioning, you know, skilled care in a nursing home, well, if she did this at least 5 years ago, guess what? None of this counts against her for Medicaid anymore, not $1 of it. Or at that time, if she wants to take money out and pay for her care, great, go ahead and do it, right? It gives you options. And I touched on something else that's important, right? We do this a lot to protect money from long-term care costs. That's one of the main reasons people do trust with our firm. In order for that to be effective, you have to do it at least 5 years before you're going to need long-term care because of that 5-year look back, right? The way that we put assets in a trust, gang, is we give them away to the trust. It's a gift that you make. So if you do it less than 5 years from when you need a nursing home, Medicaid will see that you made all those gifts, and you're still going to have that problem. It is still the way to beat the nursing home, giving things away, but as you can see, if you give it away to a trust, can this trust get divorced? No. Can it get sick and need a nursing home? Nope. Can it cause a car accident and get sued? Exactly, right? Giving things away is still the right strategy. Just give them away to a trust because nothing can go wrong with that trust. And we can set them up nowadays, folks, where we're in control, right? That's the whole key. Remember, estate planning land, right? What's the most important thing? Maintain control, right? When we would give things away to our kids, do we control it anymore? Certainly not, right? If we give it away to a trust, you absolutely can still control it. Now, Jeff has also mentioned testamentary trust today. Ooh, that's a big fancy word, right? What the heck does that mean? Well, it just means when it gets created, all right? A trust I just described for you right now was a living trust. That's one we create while we're alive to try and protect things for ourselves. But a testamentary trust is different. That's a trust that's created in your will, and it comes to life when you die so that you can give asset protection to the other people you're leaving things to in life. And these are very valuable estate planning tools, gang. We use them probably every day at our firm because they cover a lot of very common situations we deal with. For example, disabled loved ones, right? We have a lot of families who have disabled loved ones they want to leave money to, but if they would leave money directly to a disabled person, it's a bad idea. Number one, people who have a disability are usually receiving some type of a government benefit to help them out in life. And those benefits are what we call means-tested programs. You can only own so many assets and still qualify. So what would happen a lot of times to people with disabilities is they would come into money unexpectedly. And inheritance is usually the way it happens, right? Oh, great, Graham left you $10,000 in her will. Well, guess what's going to happen now? You're going to inherit $10,000. You're going to lose all your government benefits that have been helping you in life. You're going to have to spend Graham's $10,000 replacing everything the government was paying for until it's gone, and then you can get back on benefits. Sound good, right? Pretty dumb scenario, right? What you can do instead is you could leave things to a disabled loved one in a special needs testamentary trust. That's a great vehicle for somebody in that situation because all the assets you leave them will not count against them for government benefits. They get to keep those. They'll have help in somebody to help them manage and use that money, and they can still spend it on anything they want as long as it's enhancing their quality of life. And Jeff's going to teach about those in detail here after lunch. Again, another place we use these very commonly were with retirement accounts, all right? Now, when I reference retirement accounts for you non-financial professionals in the room, what I'm talking about are tax-deferred investment accounts. Things like IRAs, 401ks, 403bs, right? These are great investment tools because of the deal the government makes with you. You can grow your money before you pay the tax on it. Good thing, right? That means more money to grow, grows faster. But because the government gives you that special privilege, there are some other special rules that go along with those types of accounts. For example, you cannot place a retirement account into a trust while you're alive. If you would do that, it's like liquidating that account. You'd have to pay back all the income tax consequences at once, which makes no sense. But while you can't place a retirement account into a trust while you're alive, you can send it to a trust when you die. And that was one of the most common strategies Jeff and Carrie and I would take to protect retirement accounts. We would have clients who, each have maybe a big IRA, right? And they can't place them in trust while they're alive, but they could do it when they die. So in their will, we rewrite it so that they're not leaving things directly to their spouse. We create a testamentary trust for their spouse. Then we would change the beneficiary designation from being the spouse as a person on that account to the trust we create in that will for that person. And what would happen then is when the first spouse dies, their IRA does not go to the survivor, it goes into a trust, and this is what the survivor inherits, okay? A fully funded, irrevocable asset protection trust that works very similar to what I just showed you. Your spouse who inherits it is their own trustee, right? So they're in control of that IRA. They can manage it at their own at that point. The same rule still applies. They can't reach in, take things out, and just give it to themselves, all right? That's what gives them the protection. But if they want to get money out of a testamentary trust, it's even easier than it is with a living trust. They don't have to give the money away to anybody. What they're allowed to do is when they want to take money out, they can hire a second trustee. This other trustee only has one job with regards to this trust. Tell them yes or no when they want to take money out. Pretty big deal, all right? So how much control your spouse has depends on who this other person is. Well, again, when I'm writing these for a spouse or someone that we're not worried about, we don't want to limit them in any way, gang. We just want to make sure they have protection and they can use it if they want. So what I say in the will is, hey, spouse, when you need to hire this second person, pick whoever you want. I don't care, all right? Pick another family member, pick one of your kids, pick a friend, pay a lawyer. And trust me, if you pay a lawyer, we'll tell you yes for anything, all right? That's what we do, okay? But what if this person tells the spouse no? Well, in the will, I give the spouse the right to fire this person for any reason they want. So if they're told no, they just get rid of them, pick somebody else, and they can do that as many times as they need to, gang. That's how they know they can always get in here and get whatever money they want out. But this has the same effect, right? If after their spouse is gone and they cause a car accident, no lawsuit can touch that IRA that's in here. If they get sick and need a nursing home, even if it happens the day after their spouse dies, not a dollar of that IRA is going to count against them for Medicaid purposes, right? So that's why at this point in our careers, we pretty much feel like outright distributions are always a bad idea, okay? Yes, question?
Is it still an IRA when it goes in there, or
It
has
is.
the IRA been liquidated to go in there?
Stays an IRA. Yeah, it stays the same. That's just what owns it now. Yes, other question?
Wouldn't we have compressed distribution rules, or if it's a non-spouse?
Yes. So the Secure Act, right? Okay. I'm going to ruin a little bit of the surprise because my curly-haired friend's going to tell you about this in more detail in a few minutes. The Secure Act, for those of you who don't know, was a law that was passed a few years ago that changed everything about our IRAs when we leave them to other people, all right? It used to be when we left an IRA to a child, for example. The child didn't have to empty out that IRA until their life expectancy table said it had to be empty, all right? So they could stretch it out over their entire life expectancy, meaning they only had to take a little bit out of that IRA every year, and that helped them out from a tax perspective, right? It kept them in the same tax bracket. It wasn't a lot of extra income for them. But that's what our government didn't like, all right? They didn't like waiting 2 generations to get their income tax money paid back to them. So about 2 years ago, I believe on December 23rd at like 9 o'clock at night, our Congress, who can't even agree on what day it is anymore, unanimously passed the Secure Act, all right? And here's what the change is now. Now when you leave those IRAs to other people besides your spouse, those IRAs have to be emptied out within 10 years from when the person died. A much stricter schedule, right? And what happens is this. If things go the way we think, right, by the time we pass away, our children are probably earning the most money they ever will in their lives. They're at the end of their career, for Pete's sake. And what they're going to have to do then is take your IRA and add 1/10 of that to their income every year, right? Putting them in a higher tax bracket, making Uncle Sam more money. That's a problem with these trusts, all right? Now, for a spouse is exempt from the Secure Act, all right? Thank you, Uncle Sam. By the way, we marry people the same age as us typically, so what a big favor they did for us, right? But for your kids, it still applies, all right? So if that IRA ends up in a trust like this, well, a testamentary trust has its own tax ID number and has to pay income tax. And the problem with that is that trusts pay the same tax rates that we do as people, only they're compressed way down, all right? You get to that awful 37.5% tax rate at like $17,000 in income, I believe. So when these go to a child, if there's an IRA in trust, now the child has to make a choice, all right? They have to decide if it's more important to keep the protection and pay more in tax or give up the protection and pay less in tax. Because the way that we set them up at our firm, we give them that option, all right? We still do this so that it goes to the kids that way, but once the child's ready to inherit, let's just do a hypothetical. Let's say life's going well for that person, right? They're in a stable marriage, they are healthy, they have no issues, they're financially secure. Well, they don't need the protection as much. So what they're going to do is they're going to hire that other person, take the IRA out of the trust, right, and just empty it out at their own effective tax rate. But let's say at that point, when the parent dies, it's a different scenario. The child just caused a car accident 3 months ago, and 3 people died. They're about to get sued for millions of dollars potentially. Do you think they're going to take that IRA out of that trust? No way, right? They're going to pay the higher tax, keep the protection, and know that they can protect whatever's left, right? So fabulous question. You got us a little bit ahead on the Secure Act, but that's how that all plays together, all right? Now, oh yes, another question.
It would still be a countable asset though. You're doing the transfer on death, but for the person that has it, it's still a countable asset, right?
No, and here's why, all right? The question was, is that still a countable asset for Medicaid, I assume, right? For the nursing home. Well, let's walk through it, okay? I'm spouse 1, and I own this IRA in my name, Dan. Janice, my wife, does not own this IRA, right? It's only in my name. If I make the beneficiary a trust instead of Janice, when I die, this is where this goes. Did Janice ever own that IRA as Janice? No, right? Did Janice have to give it away? She never owned it. That's why it's not countable.
I'm talking about when he's alive. Let's say the person's alive, okay, this is before death.
Yeah, yeah.
That's a countable asset.
100%, yes. Yes, thank you. So the question was, while the person's alive, is the IRA a countable asset? You betcha, all right? The person who gets sick in Pennsylvania, their retirement accounts are a countable asset for Medicaid. The person who's healthy, if you're married and your spouse is not sick, their retirement accounts are exempt. All right, that's what's a nice rule in Pennsylvania. But the person who needs the care, yes, their retirement accounts are countable assets, 100%. Yep. Now, like we talked about, guys, a trust is part of your overall estate plan, all right? It's what helps us control that process a little bit better. Again, there's not a lot of differences between probate and trust administration, but it's a little more private. What's important, though, is to make sure that you actually put things in your trust. And I know that sounds crazy, but like Jeff had mentioned, there are a lot of firms who used to do these kinds of trusts, and they just would give it to the person and say good luck. And the person who paid for the trust or purchased it doesn't realize that unless you actually put the things in the name of the trust, it's not doing anything for you, all right? So you always, when you do a trust, need to reevaluate and look at how all of your assets are titled, reevaluate all of your beneficiary designations, and of course, we do that with everyone that we do. We have an employee whose only job is to make sure those things happen. Now, the type of trust I started out describing is what we call a grantor trust. When you create it and you control what's inside as the trustee, there's no tax consequence to that type of trust, all right? It doesn't have its own tax ID number. It's just identified by the person's social security number. And that's important because that means, again, that if there's any tax consequence on something inside the trust, it's still just reported and paid on the person's individual 1040. All right, there's no difference in that. No new tax rate, no new tax return. A non-grantor trust is different, all right? Non-grantor trusts are something that we don't do very often because who would like to give up control of their assets? Oh, nobody again, right? Well, look, with a non-grantor trust, that's what you have to do. You have to put somebody else in charge as trustee, effectively giving up control. So why in the world would somebody do that? 2 scenarios. If you are lucky enough to have more than $12,040,000 in assets in your name, you are now over the federal estate tax limit. And anything above that that you pass to your family is going to get taxed at 40%, which is not good. So what you can do to reduce your overall estate is you can put extra assets into a non-grantor trust, all right? You give up control, give it to somebody else effectively before you die, and that way you're not going to have control anymore and you'll avoid that inheritance tax problem. But again, that's a different animal, right? It's going to have its own tax ID number. It's going to pay trust tax rates on any income earned on those assets. So that's something that if anybody here has that problem, again, would be happy to talk to you about, but not many people do, all right?
They can pass through though, right? The taxes.
Not with a non-grantor trust. Not with a non-grantor, only with a grantor trust. The other difference, or excuse me, the other place we use these is with VA benefits, all right? Again, Jeff's going to talk about this in a little while. Veterans benefits is what we call VA aid and attendance. A couple years ago, they changed the rules about who can qualify for these, and they make it very hard to qualify, but you can also give away excess assets to a non-grantor trust to get qualified for VA benefits, which is something sometimes people need to do. Now, again, that difference is everything, right, guys? Because if it's a tax consequence, if you're in control of the trust as the grantor, there's essentially no tax consequence. We can do irrevocable ones, like I just mentioned, right, for the nursing home. But if you're going to do it for either tax planning or the VA, you have to look into those non-grantor trusts, and the negative there is, like I said, you're giving up control, which is a very different animal. Now, revocable trusts are something that we used to do very infrequently, all right? And if you think about it, you can see why, right? A revocable trust doesn't protect our assets, guys. It just doesn't do that. The main reason people used to do revocable trusts were so they could avoid probate. If you think about it, remember, what goes through probate? Well, things that we own in our name alone, right? So the way to avoid that is don't own anything in your name when you die. The way you can do that is you can give everything you own away to a trust, and that's why people would do revocable trust. It was a way to avoid the consequences of probate. To be honest with you, the consequences of probate, in our opinion, aren't that terrible, okay? Remember, guys, if you don't go through probate because you have everything in a trust, you're still going to go through trust administration anyways, all right? It's a almost identical process that you're going to go through. It's a little bit less expensive, okay, to go through trust administration than it is probate. Yes, question in the back.
Isn't it advantageous if you have real estate in multiple states?
Wow, you could be up here teaching this. That was a great question, all right? The question was, isn't it advantageous to avoid probate if you own assets in more than one state? 100% yes. There are basically three categories of people who need to avoid probate. That's the first one, all right? You have to go through probate in each state in which you own assets in your name alone when you die. So if you have a house here in Pennsylvania, a beach condo down in South Carolina, and maybe a cabin up in New York State, well, when you die, your family's going to go through probate in Pennsylvania, South Carolina, and New York, right? 3 times the cost, 3 times the hassle. You should avoid probate if that's the case. Put all of that real estate in a trust, and it all lives where the trust lives at that point, all right? The second category of people who need to avoid that are people who, let's say they're a very important public figure, okay, and they don't want anybody to know how much money they own when they die because it might be embarrassing to their kids. Well, in probate, that process happens at the courthouse, all right, and it's public, right? Public information can be found at the courthouse so people can find out how much you have when you die. So if that's your concern, another reason to avoid probate. A third reason to avoid probate would be if you're overly concerned that someone's going to try and challenge your estate plan after you die. Well, that's a little easier to do in probate than it is in trust administration. All right, so those are the 3 classic reasons to do that. But outside of those categories, folks, again, there's not really much reason to avoid probate, and that's why we don't see many revocable trusts here in Pennsylvania. I say that with a great big asterisk, though. Jeff touched on another problem we've been having lately. Again, one of our most common protection strategies is to do a testamentary trust, right? If you only own retirement accounts, well, that's the easy solution, right? Redo your will, have the trust created at death, very easy. The problem we've run into is financial institutions are now starting to refuse to name a testamentary trust as a beneficiary. They insist on only designating a living trust as a beneficiary because it's in existence, I suppose. I think the real reason is when a lawyer who works for a financial institution sees the word trust, the confused mind says no, like Jeff said. Well, you can't do that because I don't know what it is. Well, yes, actually we can, but so what we're doing to work around that problem is we're doing more revocable trust nowadays. If we have a revocable trust, it can exist now and it can effectively serve as a catcher's mitt, all right, for those retirement accounts. They'll go to that revocable trust first and then into an irrevocable separate shared trust for your loved ones after you're gone. Now, again, we know there are other types of trust. Those irrevocable trusts for tax purposes have the negative, no control. All right, to me, that's everything, obviously. And it's only for people who have more than, it's now 12,040,000. That's an old number. So again, we don't see many of those either, guys. We also don't do much work with VA because the rule change makes it very hard for anybody to qualify. All right, not many people do. Yes, question?
I want to go back to your last comment about the financial institution.
Yes.
And not accepting. So what are you doing for the clients that already have that in their will?
If they already accepted it, right, if the financial institution already accepted it, then it's valid. I mean, they're going to have to live up to that. It's a new problem we're seeing. It's only really cropped up in the last year. So the ones that we've done are okay. We're just having a hard time getting people to do it going forward, and that's going to be our workaround now. It's a little more expensive for folks, but it's the only thing we can really do with some institutions. I've even had, I forget which one it was, some institution, when I had that designation, they made me create my own designation form for them, and they told me all the language they had. I mean, it was crazy what they made me do. It's just easier to just do a living trust nowadays and name that. That makes them happy.
But
Yeah.
if they're already existing, they do still have to accept.
Oh yeah, it's still up in the air. Exactly right. Yes, but there's a much higher chance they're going to be okay with that. All right. Now remember, control's everything, and protecting our loved ones is everything, guys. And the reason this slide is in here is to remind you of the main reason why people do a trust: asset protection. Right? Be it from whatever. Okay, it could be from, like I said, the fear of a lawsuit, the fear of losing money to long-term care. You could even have one of the more classic reasons to do a trust. We only used to do trusts for people we can't trust, right? Maybe you have a child who's terrible with money, right? Or perhaps you have a loved one you want to leave money to, but they have a history of an addiction problem. Think about that. If you leave an outright distribution to somebody who has an addiction issue, it could kill them, all right? If you leave it to somebody who can control it for them in a trust, they can benefit from that and it's not going to be harmful. Now, we do other separate types within irrevocable trust family. There are different types we can do. Income and principal came out with somebody had a question. It can be common that when we have a trust like this, we want to set it up so that you can take income out directly, all right? Easy example, you own 3 rental properties, right? And you want to get them out of your name and keep them safe, so you put all 3 rental properties into a trust, but the income from those rental properties is how you pay your bills, right? You don't want to have to give away that income to somebody else every month, get it back, and then pay your bills. So what we can create is what we call a My Income Trust. That's a trust that allows the income to come out directly, all right? So you can just take it out, use it however you want it. The negative with that is obviously that income is not protected, all right, because you can take it out directly, but whatever income you don't use by the end of the year under our trust become principal. So it's just a way to let you use what you need. The most common type that we do, though, is what we call a family income trust, where both the income and the principal is designed to stay inside the trust. It's not that people only put extra money in there, but a lot of times when we're going through the funding process, clients want to make sure that they don't put every single thing they own in here, right? They want to leave something out so they can keep living life the same way they have. Maybe a savings account with a couple $1,000s or even $20,000, $30,000, right? So you have it at your disposal. So the funding process becomes key. You always have to counsel your client through that to make sure we're only protecting the things we know they're going to want to put in there, and we leave enough out of the trust so they're still living life the same way they always have. Okay, now we're going to go back to that hypothetical we started with earlier to illustrate this point again, right? Remember, when we leave things to people directly, bad things can happen, right? When we leave things to people in trust, it's a different story, right? We can protect from the things that go wrong. We can put other controls to make sure they're taken care of. That's why, like I was saying earlier, we're to the point where we don't believe it's ever a good idea to rely on outright distributions. Nobody knows what can go wrong for your family after you're gone, guys, and it's so easy nowadays to set things up to where it can be protected. You don't have to limit your family members by doing that, all right? That was the big negative previously, but now things are different. Now, when you work with us at our firm, again, Jeff kind of touched on this, we have a very wonderful system where you come, watch an educational workshop, and then if you watch that workshop, you get to come in and meet with me or Carrie and have what we call a vision meeting. A vision meeting is what we call a consultation, all right? We don't charge for our consultations. Like Jeff mentioned, our philosophy is we don't want people to not know what to do just because somebody's sick and they have to pay for questions getting answered. That's what keeps people from getting information, guys. That's the barrier, the institutional practice of law, right? Pay me to get to know me and then pay me every 5 minutes you talk to me, right? It's a terrible business model, right? Why would I want to work with someone that I can't talk to unless they charge me? It's pretty basic, right? So we do it differently. When you come in for a vision meeting with us, this is what you go home with, okay? This is what we call our vision clarifier, and it's basically just a menu of what the estate plans are that we offer. And when you have a consultation with us, we kind of walk you through these things. We cross out the ones that we know don't apply for you. The ones that do, we'll write notes on so you can understand and remember how they work. And we even write our prices right in there so that you know exactly what it would cost to get these things done if that's something you want to do. And we send you home to think about it, all right? Now, again, we have a couple slides here just to illustrate the important parts of these trusts and how they work. Like we talked about, we can do trust where we can get income out, all right, directly, those MITs, M-I-Ts, My Income Trust. Or we can also do what we will call a closed box, right? That's a My Family Trust where we're keeping everything inside of it so that nothing can come out without being protected. And like I mentioned earlier, funding is everything, okay? Again, so many clients come into us and they've done a trust years and years ago. And when I ask them what's in it, they look at me with a blank stare. What do you mean, what's in it? Well, did you do a new deed to transfer your house in here? Well, I don't know. Well, did you change the name on your investment account so that it's owned by the trust? Well, I don't know, all right? That's what the mistakes are made, all right? If you have a nice fancy trust but you never put anything in it, it's going to be a nice fancy trust that does nothing for you ever, all right? So funding is everything in that regard, and that's part of our process. When you do a trust with us, we always make sure we walk through every asset you have and figure out where it needs to be. Now, again, when we put the things in here, it's like adding the boxes to our wagon, right? You always want to leave some outside, like I said, just so you have easy access to cash, make it easy without, giving away and getting back. And you can never take things out and give it directly to yourself, all right? That's the most important rule. If you do that, you're violating the terms of your trust, and it can negate everything you've tried to do from an asset protection standpoint. And again, that's why when we work with people, we're always willing to counsel them through that process. It's not very common that people take things out of a trust. I'll be honest with you, all right? There's usually enough left outside of it. They don't have to do that. But sometimes things come up, People do come into money later on in life. Maybe they receive an inheritance. Well, can I add that to my trust now, even though I did it 5 years ago? Sure, you can put new things in there. Keep in mind that it'll take 5 more years for that particular asset to be safe from Medicaid, but why not, right? Get it in there and try and protect it. Again, once you have your assets in your trust, you don't give up control. That's what this illustrates, all right? If something happens and you drop your handle of your wagon in life because you get sick, you'll have other people named in there to pick it up and carry it along for you. They'll follow the rules you left them. They'll take care of you. That's the whole point in having it, right? Now remember, the one thing we can't put in a trust, retirement accounts, okay? We can't put them in there while we're alive, but we can send it to one when we die. And that's what always becomes a hang-up for folks, Again, a third of what we do at our firm is we help people through that Medicaid crisis situation. I didn't plan ahead for the nursing home, but it happened to me or my spouse. What can we do? Well, what drives me crazy is the government protects our retirement accounts from lawsuits, right? If you get sued, they can't take your IRA away from you because you need that. But while they protect it from things like lawsuits, they don't protect it from Medicaid for some reason. And that's why, like we talked about earlier, right? The person who's sick usually have to liquidate their retirement account to protect it if that would happen. All right, now, We don't just do these trusts for the nursing home issue, all right? There are a lot of other things that come up where a trust can be a lot of help. And this slide is going to help remind you of some of those other scenarios where this can be useful, all right? Number one, blended families, all right? If you're in a second marriage, you probably definitely want to take care of your spouse financially if you die first, right? No doubt about that. But if your spouse who survives you doesn't need all of your money to do that, you'd probably like that money to go back to your family line instead of going to step family, right? Well, that's a pretty hard thing to do with a will, because once you leave things to people in a will, it's up to them what they do with it, right? But if you have a trust, you can manipulate that and you can control where things go after the first person dies. You may have, like I said, a special needs loved one, right? We touched on that. If you have a beneficiary who has a disability, again, you don't want to leave the money directly. It's a bad idea for a lot of reasons. Another place a trust can be very helpful. Like we talked about, you may have that more common situation where you have somebody you're worried about, right? Maybe a child is just really bad with money, or they're in a bad relationship, or like I said, they have an addiction issue. Again, you don't want to leave the money directly, consider a trust. So a lot of other areas where they can be helpful, but again, like I said, that's what the whole comprehensive process does. And using a comprehensive process is important for the reasons I've mentioned, like I said. You want to involve not just a lawyer, okay, for example, who could get these things set up for you. Involve your financial professionals, right? They're the ones who are managing your assets. They know how they're titled. They know what the beneficiaries are. When you work together as a team like that, you're going to get a much better result, whatever you do, whether it's a will or a trust. All right. Well, it's time for our case study, which we're going to go over. And we still have lots of time before lunch. Do you want to read the case study, or do you want me to do it? Yeah. Or do you want to come back to that later when we can get through more stuff before lunch? Yeah. We could do that, right? I'll ruin the surprise. It's a very convoluted hypothetical with lots of issues, all right? There you go, partner.
Yeah, right. Bill just said, I don't think Jeff's hair is any curlier than Dan's, so he always calls me curly hair, yeah. You know, the best thing about that hypothetical that we skipped over, but it just comes all back to making sure the beneficiaries are pointing to where you want them to be pointed to. If you don't point things properly or you don't fund them properly, they don't do anything, right? And then the 18-year-old inherits money, and you weren't intending that, and it goes to all of their places that you don't want it to go. So, all right, so let's talk about the Secure Act. Man, it was December 23rd, and it was actually like 2:30 in the morning. And I know you said 9, but it was like in the middle of the night when they passed it. I'm sure that wasn't coincidental, do you think? I don't know. So let's take a minute and go back. What were the good old days, right? The good old days were, you have this retirement account, you put it into the trust, right? We make it an accumulation trust. The money then goes in there. It allows to accumulate, stays in the trust, full-blown asset protection, stretch it out over the person's life expectancy. Man, you can't lose, right? Money's immediately protected from long-term care for the person receiving it. All right, so what did the Secure Act do? Well, what it did is it says, okay, for a spouse, you can stretch it out over your life expectancy, but it has to be a conduit trust. Anyone know what a conduit trust is? Well, with an accumulation, we can accumulate it in the trust. With a conduit, every time you take a distribution over your life expectancy, you have to take that piece out of the trust. So when the life expectancy of the spouse finally hits, all of the money is where? That's got to be out of the trust. So with a spouse, we can still do the trust, absolutely. But we have to set it up in such a way that every year when you take that, and I don't know if they still call it RMDs, but I think if I use that word, you all know what I mean, right? When they take the required distribution out, it has to come out of the trust. You lose the asset protection. So the way that we do our funding and we do layered funding, right? What that means is the first beneficiary is always going to be what? The trust. Always the trust. The second beneficiary is always going to be the spouse. If I name the spouse first and the spouse disclaims the inheritance, will that work for Medicaid purposes? Everybody say no. No, why? Because she had a right to it. If I disclaim, the government says, oh no, you can't disclaim, we're forcing you to take it. But if it goes to the trust first, and the trustee, who happens to be the spouse, funny, if the trustee disclaims, it's not the spouse disclaiming, is it? Oh no, it's the trustee disclaiming. So the reason we do that is because I want to evaluate at the time of the person's death, is it better to leave it in the trust and pay all the taxes in a 5-year period and then pay the higher trust tax every year, or let it go through? Because if I let it go through, ultimately, where's all the money? To the spouse, and then he or she can do whatever they want with it. And they could also lose it. Make sense? All right. Now, that's with a spouse. Let's talk about with children. How many years do children have? 10 years. Same concept. They've got 10 years, but it's also a conduit trust. So which means over the 11 taxable years that you're taking all this money out, where does it have to go? It has to come through to the individual. Same conversation. I always want to name the trust first, and then the individual child second, because the trust can disclaim, the child can't. Right? Now, after 10 years, what happens? The money's all out anyway. So we're struggling, right? What is typically the biggest asset of an individual? Right? Right? Yes, Denise.
If you have the retirement, your IRA in one trust, and you have another trust, the distribution from the IRA can go into the second trust, and by tax at the higher tax rate.
Well, the way you would do that, yeah. So the way you would do that is just a visual for me. So we'd have to force it out of the protected trust, and then I could put it in another trust. But how many years is the look back? So yes, we're doing a lot of that.
For like my clients that have the separate shared trusts,
Mm-hmm.
right, so they have two different trusts.
Right.
One has regular assets in,
Correct.
taxable assets, and the other one has the IRA. So we have it go into the regular trust.
No.
And then pass out, go through.
Well, okay, as long as it passes out. It has to pass through and out. The government, for whatever reason, and this is what I don't understand, I get why they wanted their taxes sooner. I mean, that part I get. But why they cared that we have to force it out,
Right,
I don't understand that part.
right, because you're still getting their taxes, it's just
Yeah.
at a higher rate.
So what do they care?
Right.
So I honestly, I tend to be sarcastic at times. This is one that I'm not. I'm being genuinely honest. What do they care?
Yeah.
I mean, you allow...
Actually would benefit better from it.
I would think so. So here's what we're struggling with, and this is, from our planning perspective, the biggest asset that most people have is a retirement account, right? Especially because in the old days, defer. Statistics, numbers, examples always show that you're going to make way more money tax deferred, right? I mean, that's a very simple concept. But from the asset protection perspective, when we get into long-term care land that Dan taught you earlier, if you end up in the nursing home, Pennsylvania says you have to liquidate your retirement account. Now, you liquidate $1 million retirement account. Not only are you paying 40%, 39.6 or whatever, not only are you paying 40% in tax, but what happens the next year to your Medicare Part B premiums? They go through the roof, right? So where we struggle, and this is where we're trying to work with the advisors, is what's the best scenario? What's the best decision? I mean, there's no right answer, first of all. Let me start there. So you don't think I don't have an answer. But what we're trying to get people to realize is we need to start thinking about the beneficiaries. In the old days, it was defer for the rest of their life. We don't have that. We got 10 years. Statistically speaking, when the people are passing away, their children are in their 50s and 60s. When is the highest wage earning years of most individuals? In their 50s and 60s, right? So now they're inheriting this money and they're having to pay as ordinary income the distribution that they're receiving, and they have to receive all of it over a 10-year period. So we just had a client that it was $1 million, so they're taking $100,000 a year. Well, you take $100,000 from someone who's already making $250,000, $300,000. That's a big deal. I mean, you're now in the 39.6% tax bracket. And I tried years ago, like just when Secure Act came out, it was over Zoom. And I think the issue is when you're over Zoom, I think it's very hard sometimes to create a relationship, to explain to this client, you're at this rate currently because you're retired. Your kids are at this rate, and they're going to have to realize 100% of it in 10 years. Now, he died quick enough that it didn't matter at the end of the day, but it could have, right? He could have lived 10, 15 years. My plan was let's distribute it out over the next 10, 15 years. Bring it down, and then that way, even if you ended up in a nursing home, instead of $1 million retirement account, now I'm only dealing with $500,000.
And also, when you're looking at having the RMD at age 72,
Yeah.
I've been trying to do a plan, somebody starts retirement, right? I'm having them do conversions,
Yeah.
conversions every year.
Yeah.
Because that's not,
And I think you're seeing a lot of that. You're seeing a lot of Roth conversions. Now, if we're working mutually on a client, right, and this is just the fun part of these trusts, if we're working together on a client who did a trust, an asset protection trust, the theory that we have is rather than convert it into a Roth, like what's the advantage of the Roth? Right? No tax-free, future tax-free growth, right? So if you put it in the Roth, the growth is tax-free. If I put it into the trust, I've already paid the tax on it, right? I take the remainder and I put it in a trust. What's the whole point of these trusts in reality? It's to let them grow, right? Just let them grow, let them sit there, because we're going to leave plenty of money in their own name. I mean, they got their retirement account, they got other money. If this just grows and I never pull the money out, do I ever realize the capital gains? No. The person dies, what do I get? Step up in basis for the kids. Same thing as a Roth. If I own a Roth and I go into a nursing home, is it a countable resource? Yeah. If it's in the trust, is it a countable resource? Not if it's outside of 5 years, right? So that's where we work together on. Roths are great. And if they don't have a trust, by all means. But if they've got a trust, that's the same effective result, right? You're not going to pull money out of it because they got tons of money over here, but it's protected here. It's not protected as a Roth. So when we first built the materials for this, I worked with a national company that I teach for, and we had all these calculations and how to calculate the beneficiary's annual income and their effective tax rate, and we did this whole section, marginal versus effective, and all of the feedback that we were getting from the events that we've done was, dude, you're way in the weeds. Who cares? Like, at the end of the day, that's a conversation we'll have together. We're glad you have a formula for it. Great, we'll pull it out when we need it, and we'll run the numbers. All I was trying to show people was, I think we need to start looking ahead now, more than ever, right? Look down the road. Look at the beneficiaries. And for the advisors, what better way to build a relationship with the kids of the parent that you're working with by saying to them, we want to have a meeting with your parents to discuss this. You're worried about them, and you're worried about them 15, 20 years down the road. What a way to build a relationship with the children, to keep that money within your firm and your company down the road, right? Show them that you're thinking ahead. Show them that you're running calculations. So that's the part that we're treading very lightly right now, because a lot of times, if it hasn't happened to the family, meaning they haven't had someone enter a nursing home, What's the answer? It'll never happen to me. Right? So when you're trying to get someone to start to bring down a retirement account, and that's going to trigger taxes for something that they don't believe will ever happen to them, guess what? They're not doing it, right? They're not doing it. But that's where I think together as advisors and professionals to say to people, you got a 1 in 3 chance. You know, if there's 3 people, 1 in the 3 of us is probably going to end up in a nursing home. Now, one of the most misleading statistics of a nursing home, go ahead and all shout out 2.5 years. What's the average stay in a nursing home? 2.5 years, right? Look at the statistic. Most people die in the first 90 days. Statistically, you're likely not to make it 90 days in a nursing home. But if you make it 90 days, guess what the average stay is? 6 years. Okay, now average them. You see where we get to 2.5 to 3 years. But when you're making a determination to buy long-term care insurance, you're making a determination to do a trust, right? That math skews it a little bit, right? Because if I'm only going to make it 90 days, I'm not worrying about. Now, I still worry about long-term care because I want to stay in the home. But for an average individual who thinks they're only worried about the nursing home, they're going to say, what? I'll pay for that. Oh, but if you don't die, you're going to live 6 years. The average stay in a nursing home right now in the state of Pennsylvania is over $14,000 a month. In York and Lancaster, we're at about 12 to 12.5, but the average in PA is over 14. So that's where we're trying to get to these clients to say, it's great that you have $1.5 million in a retirement account, but if you have dementia, you might live 6 to 10 years in a nursing home. At $14,000 a month, how long is it going to last? Not ridiculously long, right? Now, the one thing the Secure Act did do, there's one good thing. Special needs. They did allow for us to stretch the retirement accounts over the life expectancy of a special needs child and allowed us to use an accumulation trust. So that effectively means that I can fund it, protect 100% of it, and allow it to remain protected. So thank you, government. You did one thing right. Right? That's an interesting twist because before the Secure Act said that, what did we all tell people to do with special needs trusts? Never put retirement accounts into a special needs trust, right? I mean, I always tell people that. Well, that's easier. Just don't avoid it. Don't put the retirement assets in the special needs trust. Now, with the Secure Act, what are you almost encouraged to do? Use retirement assets into a special needs trust because you can stretch it out over the life expectancy. So just thank you for one thing. Thank you for allowing us to have the special needs to still stretch out over a person's life expectancy. They also have, if the beneficiary is within 10 years of the age of the person whose retirement account it is, gee, thank you. You're so sweet. But again, that is also a conduit trust. So they have to force the distributions out of the trust. Now, yeah.
I understand the benefits of the spouse and then also the children, but it's people are living longer now. They may not get married again and become a spouse. How is this significant other, like a boyfriend or girlfriend, later in life? How are they treated? Is that a 10-year rule as well? As far as the
Yeah, I believe they just fall under the classification of other. I believe it's just the 10 years. Am I right on that? I think they all kind of fall under the 10-year payout. Yeah. Angie.
When you were talking about the different types of the testamentary trust and being taxed, when you have to start taking out the estate tax rate versus the beneficiaries income tax rate?
It goes to the beneficiary.
Yeah, so
It's individual.
So to the testamentary trust, I'm going to K1 that income to the individual, so they're going to pay at their individual rates. Yeah. So the question was, with the testamentary trust and the beneficiary receives a testamentary trust at death, when it goes into the separate share trust, that's a non-grantor trust at death. It's an irrevocable trust. But what we can do with the beneficiary is K1 the income to the beneficiary and pay at their individual rates. Is that the question?
Withdraw it.
Yes.
Yeah.
Yeah.
So any income earned by the end of the year, if it passes, if it's distributed, then it's taxed at the individual's rate and not the trust rate.
So if you take the money and distribute it, you can pay at the individual rate. But if we distribute it, where must the money go? Out of the trust. You see the conflict? And this is where, and I have a master's in tax. I feel like I have to say that. I feel like I have got to throw that out there. Sometimes I think it's better to pay higher taxes. I'd rather pay higher taxes than lose the asset, right? And I know that just is flabbergasting for some people, but that's why we do that layered funding. That's why when you look at our beneficiary memos, some of you probably cringe, but I need flexibility because I can't predict the future. So there's a good chance that I am going to disclaim out of the trust. There's a very good chance that we're not going to leave it in the trust. I'd say there's probably a 90% chance. But if somebody was just in an accident, somebody just got divorced, somebody's heading into a nursing home, I would rather pay higher trust taxes. Absolutely. I'll leave it in the trust and pay higher trust taxes all day long. We did in our calculations, with about $12,750 of income out of an IRA, that's equivalent to somebody making about $171,000 to $300,000. That's the same tax bracket, right? I'm okay with that. There's not a lot of families that are making over $300,000 a year together. So in some cases, it is better to leave it in there. I'd rather pay that trust tax rate, right? And there's ways to bring down how much income we're generating if we wanted to. I mean, if that was our goal, we could do that too. So I think we all have this visceral reaction of taxes. And I do too. But I'd rather pay higher taxes than lose the entire asset. So that's where we have to just use our brains sometimes and think through what's the scenario, which is also why I'm encouraging all of you to really look at your individuals that your clients are, because the higher the IRA, the higher the 401k, if the spouse enters the nursing home, we're good. If I enter the nursing home, we're not good. And the only way to protect 100% of the asset for the spouse is to do what? To liquidate it. And we're going to talk about this in the afternoon with the Medicaid section. And that's where I'm struggling, because if the person has dementia, there's a chance that they're going to live long enough to probably justify liquidating the retirement. If they have a disease that's going to kill them in 2 years, we're just going to private pay out of the retirement account. We're going to take the deduction on the tax return to the extent that it exceeds 10% of adjusted gross income, so we get a tax benefit from it. But if they live too long, eventually that skews the decision, and we should have gone the other way. Nothing like having to make a decision without knowing the outcome, huh? And that's the hardest thing. I mean, when families come in and someone's in a nursing home and you look at the sheet and you see $1 million in a retirement account, you think to yourself, oh boy, we got a big decision to make. And it comes down to how long they're going to live. So nothing like rooting for someone to die, right? I mean, that's tough. I mean, that's what you're doing. You're saying, no, I'm going to bet on them dying sooner. So every year goes by and then someone in the family will call and they're like, we're 6 months away from making the wrong call. Yeah, but we're still okay. Well, I need dad to die. Oh. No, you don't. That's taxes, guys. That's just extra money to the government. Like, let's not lose sight of what we're really talking about, right? But that's how they feel. We made this decision and I need dad to die. Oh, that's great. That's a great way to wake up every day. So questions about the Secure Act? All right. Did anyone have any questions about the layered funding or about why we name the trust to disclaim and then the individual, or did I cover that well? Angie?
Well, I just would like to do one-on-one about that.
Yeah, and perfect. I would love that. That would be fun. When we first started coming out with these beneficiary forms after the Secure Act, you guys, for the ones who we didn't get to talk one-on-one, you must have thought I was out of my ever-loving mind because there was so many contingencies. But what we realized in kind of evaluating this for the national company is you have to have flexibility. I mean, I can't predict the future. And yeah, it's probably going to end up coming out anyway. But if you come back to our entire premise, right? Our entire premise is asset protection. I mean, ultimately, we're believing in let's protect the money. So what that's almost forcing us to do is to have people not have everything tied up in a retirement account, right? Because if I inherit the retirement account, what do I have to do to protect it? Well, I can't put it in a trust, can I? Not during my lifetime, not without triggering 100% of the taxes. So now I have to liquidate it, pay all the taxes, and then put it in. And then I have to wait 5 years. Ugh. I mean, none of that is ideal, right? I mean, in a perfect world, everybody spends down their retirement money during their lifetime. They pay the taxes and they distribute it to the kid protected in the trust. Wow, that's not smart either, right? I mean, as the advisors in you, you're probably going, no, wait a minute, Jeff. Slow down here. And I agree. I totally agree. But I'm just trying to show it's where we struggle because there's no way to, once it transfers to somebody as an inherited IRA, I'm forced to liquidate it, pay the taxes, and then wait 5 years. Not ideal. Go ahead. Tell me more about life insurance. What would it be used there for?
Well, the use of how is that the whole point is that your assets are going to continue to grow. Take a minimal amount out, the premiums on a much larger death benefit that's going to be tax-free.
Right.
And depending on how you design it, you can still have access to cash.
Yep.
I.e., it's going to be a gift to kids, or is it going to be something consumable so you can have the assets? So just from the standpoint, any money manager is expecting the assets to grow. And you're going to have to take this on these. Do the calculations about taking the monies out now when you get predictable tax brackets versus later on when you take it out and you have no idea what taxes are coming. You put monies into life insurance, you have a lot of flexibility.
Right. So what she's saying is use life insurance, spend, I believe, correct me if I state this wrong, spend down some of the retirement money, pay the taxes, use that money then to buy life insurance that will pass to the kids tax-free at death and not subject to creditors. Did I summarize that okay?
Yeah, and then there's still access to cash in certain situations too.
Right. And they would still have access to cash in certain situations for the what ifs.
But we're asking this, I mean, Medicaid still wants to know if you have the cash value.
Yeah, anything over 1,500 in life insurance is considered an available resource. So you're correct, Denise. Yes.
Question online, Jeff, any thoughts on using ILIT?
Using ILITs? Yeah, I mean, certainly. Life insurance is definitely, I think, going to be a tool that you're going to see a lot of. The purpose of an ILIT, or an irrevocable life insurance trust, is to get the money out of the estate for tax purposes. So essentially, you'd be creating an irrevocable trust, putting the life insurance into that irrevocable trust to allow it to be passed on to the future generations tax-free, and also avoiding any potential issues with Medicaid, because it's not an asset of the individual. So definitely something that I think you're going to see a lot more of.
I've had a couple instances where client had a life insurance policy with cash value, so there's 50,000 cash value, it's got 100,000 on death benefit. Client goes into the nursing home, and the nursing home says, okay, they need to cash out the life insurance. They don't have a long life expectancy. And I've tried to get nursing homes to say, well, have them just transfer ownership to you as as payment for services, and you guys own that. And that way you get 100,000 instead of 50.
And what response have you gotten, Paul?
Absolutely not.
Yeah.
I was wondering if you could
I was just curious to see if you have gotten any through. So what Paul is saying, to repeat the question, is he's had cases where somebody's in a nursing home, they're going through the Medicaid process, there's 50,000 in cash value, which is certainly over 1,500. The death benefit might be worth 100, 150, whatever the number is. But in order to get somebody qualified for Medicaid, they cannot have resources over 2,400 or over 8,000. And we'll talk about that in the afternoon. So what Paul's saying is, well, time out. You're not acting reasonable here, because if you're going to force us to take the cash value out, what happens to the death benefit? Right? I imagine it goes down, equally. So he's saying, we'll just assign the policy to you. You'll get the money. You're way better off not having us liquidate this. And I said, well, how have you done with it? And he said, not good. They say, absolutely not. And there's an example of, there are rules, and by God, we are going to follow those rules. And when I talk to caseworkers, I literally had a caseworker tell me, I said, ma'am, I know what the black and white letter of the handbook says. I know what it says. But if you'll just use common sense and logic, and just think about this logically for 1 second, What I'm doing is exactly the same thing. She said, Mr. Belomo, I am not paid to think. I am paid to follow the handbook. Now, she's not wrong. I mean, let me be very clear. She was following the letter of that. I mean, she followed it to a T. But we weren't hurting anybody by doing it the other. It wasn't hurting the government. It wasn't hurting. So Paul's point is, dude, you're going to do better off if we do it this way. We're going to make more money for you, the government, but it's not following the rule. It's not following the law. So that's why I asked you before I gave my opinion. I didn't think they would do it because I figured, well, they can't see the forest despite the trees. They're looking at the trees going, oh, no, I can't. We might make more money this way. No. They follow that handbook, man.
Client died 6 months later.
Yeah, right? And did they liquidate all the cash value?
They had already liquidated it.
So in this case, the client died 6 months later. They had to liquidate all of the cash value out of it, so the death benefit, I assume, is gone? Yeah.
Would have been 150,000 with the nursing home. The nursing home instead only got 50.
Yeah, so in that case, the nursing home would have gotten 150 because they forced all the cash value out. There was nothing left. 6 months later, the person dies. But that requires logic. Right? And they're not paid to think. And I'm not bashing the person. I think she wasn't wrong. She's paid to follow the handbook, and she did.
Non-qualified annuities, do they, that's a accountable asset?
Yes. So non-qualified annuities, Jack asked, are they an asset, accountable resource? The answer is yes. So I'm going to show my ignorance and naivety to the financial professions for a minute, just to show you how, I don't completely understand how the inner workings work. From our perspective, there's only one word that makes us cringe: annuitizing an annuity. Because essentially now that's just an asset income stream that goes to the nursing home. Once it's annuitized, it's non-transferable, non-assignable, non-everythingable is what the one caseworker told me. And once it's non-everythingable, I'm now stuck with that income stream just going to the nursing home. Now, if the person dies before it ends, then the beneficiaries can get the result. So that part could work if the person dies soon enough. But in our little world,
Go back in and try and recoup those funds. In other words, that's coming in every month the person dies. The nursing home would try to go after those funds that are still coming into the survivor.
The contingent beneficiary.
yeah, the contingent beneficiary would be able to receive the money because estate recovery can only go after probate assets. That would be considered a non-probate asset. So it could work. And there's some advisors who have said to me, we're doing this intentionally, hoping the person dies. And my answer is, well, but how about if we just protect 100% of it and we don't have to hope they die? Like, again, I don't like waking up every day hoping somebody dies as part of my plan. That doesn't make me feel good. Like, there's another way we can do this and protect 100% guaranteed. Why am I going to hope that they die? Like, I don't know. So in my world, annuities are great. I have no problem with it. It's a tool in your toolkit. Use it. But once it's annuitized, in our world, we're stuck. All the income has to go to the nursing home. I apologize. I didn't hear you.
What if it's a joint annuity? It's based on husband and wife, and they might have a lifetime income coming in for several people. One person is in a nursing home. The other spouse still is entitled to that money also.
So for a joint annuity, the remaining spouse would be entitled to the income.
It's based from day one that income will be there for both spouses.
Okay, I'll trust you. I mean, I don't. Again, what I know is during the life of the person in the nursing home, it has to go to the nursing home. That's what I know. Now, I'll believe you on the second part that if there's a spouse remaining, it will go to them for their remainder. I trust you. That's not a product I'm familiar with.
What we did, because the spouse, the healthy spouse, didn't work. So he had the IRA, which was about $950,000.
Correct.
We ended up taking the distribution out over 2 years and buying an annuity that she got the income.
Yep. So what we're going to talk about, so what Denise just basically alluded to is a community spouse annuity that was going to put 100% of the money in the community spouse's pocket. And that's a strategy that we used in one of the cases because we were fearful that the person was going to live a long time. And so because of believing they're going to live a long time, it was worth paying the taxes, getting 100% back to the spouse. But we did have to do what to the IRA? We had to liquidate it, and then we had to pay the tax consequences. And then in the subsequent year, the income for that person went up. which affected their Medicare Part B premiums. So again, part of the strategy, right? We're betting they're going to live a long time, and we're betting this is the better way to do it.